Is the Kotak Confident Retirement Builder Plan the key to a worry-free retirement or just another complex ULIP policy wrapped in promises? Let us find out the answer to this question through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us now first understand a few basic details about it. So this is a non-participating unit-linked pension individual savings product. Some of the key features of the policy are there are no premium allocation charge. So your entire premium goes into fund investment and you get to enjoy yearly additions starting from the end of the 6th policy year, and you also have a choice of 5 fund options tailored to match your risk appetite, and you can even make partial withdrawals when unexpected financial needs arise, and you get to pay for a limited term or throughout the policy duration, whichever you want, which is your choice basically, and you get to switch between funds and redirect your premiums any number of times at no extra cost. So these are some of the key features of the policy, and there are benefits like vesting or maturity benefit and death benefit. So basically, if the policyholder survives till the end of the policy term and he has paid all his premiums up to date, then the fund value as on the date of vesting will be payable as a maturity or vesting benefit. How he can utilize the benefit is either he can utilize the entire proceeds, which is 100% of the proceeds, to purchase an immediate annuity or deferred annuity from the same insurer at the then prevailing annuity rate, or he can purchase from another insurer by commuting the 50% or 60% of the proceeds and utilize the balance amount to purchase an immediate annuity or deferred annuity from the same insurer at the then prevailing annuity rate. So this is how we can utilize the vesting benefit. And in case of death benefit, in the event of death of the policyholder, unfortunately, if he has in case paid all his due premiums till the date of death, then the nominee will receive the death benefit, which shall be higher of either fund value, which is inclusive of yearly additions if we had any, or higher of the assured benefit, that is 105% of the total premiums paid till the date of death. So how we can utilize the death benefit is either the nominee can withdraw the entire proceeds of the policy or utilize the entire proceeds or part thereof for purchasing an immediate annuity or deferred annuity at the then prevailing annuity rate. And as I have previously mentioned, there are 5 fund options like Pension Classic Opportunities Fund, Pension Frontline Equity Fund, Pension Balance Fund, Kotak Nifty 500 Multicap Momentum Quality 50 Index Pension Fund, and Pension Money Market Fund 2. So all these fund options are categorized based on the percentage of allocation they have to each asset class in this tabular column, like asset classes like equity, debt, money market, and also it has been categorized according to the risk profile each fund option has. Now let's move on to understanding various charges present into this policy. So there are no premium allocation charge as I have previously mentioned, but you need to pay for charges like policy administration, fund management charge, and also discontinuance and miscellaneous charges. But there are other charges that you don't need to pay, like which are present in other policies available in the market, like switching charge, premium redirection, partial withdrawal, and mortality. But still, some of these charges that are still present under this policy continues throughout the policy term, which will be an extra overhead cost to the investor. So these charges will significantly reduce your returns in the long term period. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now let us take a look at the advantages and disadvantages of investing in this policy. The advantages are after the 5-year lock-in period, you can make up to 3 partial withdrawals during the entire policy term, and you are able to enjoy the flexibility to switch between funds or modify future premium allocations anytime free of charge, and you have the option to reduce your premium by up to 50% of the original annual amount based on your financial needs. So these are some advantages. The disadvantages are your loans cannot be availed under this plan, and instead of a cash payout at maturity, the final benefit is vested for future use, and you also have restricted partial withdrawals, which is allowed only for specific purpose such as children's higher education or marriage or home construction. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to analyze analyze the IRR of this policy, which is the internal rate of return, to understand the better cash flow patterns of this policy and how much returns we actually get at the end of the day. So for calculation purpose, let us assume that a 35-year-old male purchased this policy with a sum assured of 10.50 lakh. The policy term is 20 years and the premium paying term is 10 years with an annual premium of 1 lakh. So if the premiums are paid regularly, the benefits vest at the end of 20 years. So here in this example tabular column, we have shown two return scenarios. One is 4% per annum and 8% per annum. This is just to show you a worst and best case scenario, because it is important to note these assumed rates and bonuses are not guaranteed because they depend on the company's actual performance. So this is just to give you an example of how this policy can perform at worst and best case scenarios. So at 4% return, the vested benefit amounts to 14.76 lakh. At 8% return, the vested benefit amounts to 26.63 lakh. These amounts are not directly paid to the policyholder. Instead, they serve as the purchase price for an immediate or deferred annuity plan offered by the Kotak policy or another insurer. So the annuity rate will be based on prevailing rates at the time of investing. So since the payout is not received upfront and is instead converted into an annuity, calculating the internal rate of return on the accumulation phase alone doesn't give us the full picture. However, for reference, we can say IRR in the 4% scenario is 2.53% and the IRR in the 8% scenario is 6.41% as per the policy's maturity calculator. Even though the premiums are invested in market-linked funds, these return figures are lower than most what traditional debt instruments offer. Moreover, these returns do not include the distribution phase where the actual annuity is received, which further affects the overall benefit. So as this policy is not giving us a desirable outcome that we need, we are going to explore an alternative strategy in a comparative analysis now. So in this strategy, rather than combining the insurance and investment aspect, we are going to invest in it separately. By adopting this split approach, you can build your retirement corpus through investment options that do not impose restrictions on fund utilization, so which offers greater flexibility and control. For instance, a pure term life insurance policy with a sum assured of 10.5 lakh is available at an affordable premium of just 9,500 rupees per year for a policy term of 20 years and a premium payment term of 10 years. So in comparison, the Kotak policy requires an annual premium of 1 lakh for the same coverage. This means you can save 90,500 rupees each year by choosing a term plan and investing that amount based on your risk appetite. So if you are a conservative investor who's not willing to take a lot of risk and may prefer safer option, then you can choose public provident fund PPF. But if you are someone who's an aggressive investor and who can take a lot of high risk for high returns, then you can consider equity linked instruments like ELSS, which is equity linked savings scheme. So if the saved 90,500 is invested annually in a PPF account, the maturity value at the end of 20 years would be 26.70 lakh, delivering an internal rate of return IRR of 6.44%. While this return appears close to the IRR of 6.41% from the 8% scenario of the Kotak plan, the difference lies in accessibility, because under the split approach, the entire PPF corpus is freely available without restrictions and it is a guaranteed return also. Alternatively, investing the same amount in an ELSS fund could yield a maturity value of 55.24 lakh before taxes. But after accounting for long-term capital gains tax, the post-tax value stands at 49.62 lakh with a post-tax IRR of 10.59%. This return is significantly higher than what the Kotak plan offers, and the entire corpus is available to the investor at maturity. So if you have any doubts regarding how the ELSS tax calculated, we do have a small tabular column presented on the screen for your reference to pause and see. So in summary, separating insurance and investment not only offers better potential returns but also ensures full flexibility and access to your funds, which are advantages that are not available under the Kotak Confident Retirement Builder plan. So what is the final verdict on this video? is this policy worth investing or not? So the Kotak Confident Retirement Builder Plan invests your savings in market-linked funds to help you build a retirement corpus over time. However, the key limitation is that the maturity value is not available for your direct use. Instead of a lump sum payout, the plan offers a vesting benefit which must be used to purchase an annuity. The income you receive from this annuity depends on prevailing market annuity rates at the time of vesting, rates that are not guaranteed and are not a part of the plan itself. Moreover, the accumulated corpus at vesting is also a non-guaranteed amount as it depends on market performance. Combined with the uncertainty of future annuity rates, this creates ambiguity around how much retirement income you will receive. Ironically, this lack of clarity undermines the very confidence the plan's name suggests. Such unpredictability may lead to mistrust or dissatisfaction with this policy, and it also has a high agent commission, which is to be noted. So, retirement planning is too important to leave to chance. It demands a thoughtful, customized approach tailored to your financial goals, lifestyle need, and risk appetite. For true peace of mind in your golden years it is wise to build a retirement plan that addresses both the accumulation and distribution phases effectively. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.